If your company is loss-making but spending more than 30% of your costs on R&D, HMRC will pay you back 27 pence for every qualifying pound you spend. Not as a tax reduction, as a cash payment to your bank account. Most pre-profit founders do not know this scheme exists. It is called ERIS, the Enhanced R&D Intensive Support Scheme. In the next 7 minutes, I will show you exactly how it works, whether your company may qualify, and what the mechanics of the cash payment look like. By the end of this video, you will understand the difference between the standard merged R&D scheme and ERIS. You will know how to calculate whether your company crosses the 30% intensity threshold, and you will know how the cash payment from HMRC actually works in practice, including the PAYE cap that most advisors forget to mention. 7 minutes, let us go. This video features an AI-generated presenter. All content is for educational purposes only and does not constitute tax or financial advice. Always consult a regulated specialist for your specific circumstances. Here is the assumption that costs most early-stage founders money. We are not paying corporation tax, so there is nothing to claim. That is wrong. Under the merged R&D scheme, the credit mechanism works differently from what most people expect. A 20% credit is calculated on your qualifying expenditure. For a profitable company, it reduces the corporation tax bill. For a loss-making company with no tax bill to reduce, the legislation provides a route for that unused credit to be paid out as cash. This is not a loophole. It is the intended operation of the scheme. The UK government designed the payable credit specifically to support companies in the early stages of R&D investment before they reach profitability. And for companies that qualify for ERIS, the rate is not 20%, it is 27%. ERIS requires 2 conditions. 1. Your company must be loss-making in the accounting period. 2. Your qualifying R&D expenditure must represent at least 30% of your total expenditure for that period. The intensity calculation is where most founders get confused. Total expenditure means everything the company spent in the period. Salaries, rent, software subscriptions, professional fees, marketing, travel, all of it. The qualifying R&D expenditure is the numerator, the costs that are actually claimable. Engineer salaries apportioned for qualifying time, cloud compute costs, UK-based subcontractor costs at 65%. If those qualifying costs represent more than 30% of everything the company spent, ERIS applies. This is why the early years of a technology company are typically the best years to claim. In year 1 and 2, the cost base is dominated by engineering salaries. Sales, marketing, and overhead have not yet grown to dilute the R&D intensity. As the company scales, that 30% threshold becomes harder to maintain. Let me walk through how the cash payment actually arrives. You submit the additional information form, then the amended corporation tax return. HMRC calculates the 27% ERIS credit on your qualifying expenditure. Because your corporation tax liability is nil, the credit passes through the statutory step process set out in CTA 2009, Chapter 6A. The excess credit, what remains after any other tax offsets, is paid directly to the company's bank account. HMRC's standard processing time is 40 working days. Allow 12 weeks in your cash flow forecast to account for variability. There is one constraint on the cash payment that most advisors do not lead with, but that you need to understand. The payable credit is subject to a PAYE cap. The maximum payable credit in any period is 3 times the company's total PAYE and national insurance liability for the year, plus £20,000. For most companies with genuine R&D staff on UK PAYE, this cap does not bind. If your engineering team is on payroll, their PAYE and NIC will typically be substantial enough that the cap is not a constraint. Where it does bind is when founders are not yet taking salaries, or where most development work is done by overseas contractors who are not on UK PAYE. If that describes your situation, a specialist will calculate the exact cap and model your net cash receipt before submission. Let me give you a specific example. A pre-revenue SaaS company in its 2nd year. Total costs for the year, £1,400,000. Qualifying R&D expenditure, 8 engineers on qualifying projects, cloud costs included, £490,000. R&D intensity, £490,000 divided by £1,400,000 equals 35%. That exceeds the 30% ERIS threshold. ERIS credit at 27%, £132,300. Standard merge scheme at 20% would have been £98,000. ERIS is worth an additional £34,300 in that year alone. And for a company with no revenue and no tax liability, that £132,300 lands as a cash payment. So to bring this together, loss-making companies can receive a cash payment from HMRC under R&D tax credits. If your qualifying R&D expenditure is above 30% of your total costs, you may qualify for ERIS at 27%, not the standard 20%. The cash payment arrives within 40 working days of a complete submission. And the years when your company is most likely to qualify for ERIS, the early pre-profit years, are the same years when most founders have no idea the scheme exists. The 2-year filing window closes. It does not reopen. If anything in this video resonated with your situation, the next step is straightforward. There is a free, no-obligation specialist assessment linked in the description below. It takes 5 minutes to complete. The regulated specialists I work with operate on a no-win, no-fee basis. If your company does not qualify, there is nothing to pay and nothing to lose. The link is uplifttax.com/partners/E5J3P6. It is also pinned in the comments. If you found this useful, the video on the merged R&D scheme gives you the full rate comparison from April 2024. It is on screen now. I will see you in the next one.